All right, hello everyone. Before we go ahead and jump into it, I just want to make sure that everyone can hear me. If you could type a Y into the chat, I would be very appreciative. All right, looks like audio is working all right. All right, so I just want to welcome everyone to our webinar. We're going to do things a little bit different this time. We've got some pretty cool new things to show you, so we're going to spend a little bit of time going over that before we jump into kind of the regular flow of things. Just as a reminder to everyone, I know we always have a handful of new people. This is not really the place for technical stuff. If you guys want a little bit of feedback on markets that you're looking at, we always encourage you just to have us type it into the question box to have us take a look at some markets if you want feedback, or you took a trade or something like that, you want just again feedback on it. We're going to be going on this for about a little over an hour. And yeah, we'll try and get to all of your questions. But if we are not able to take any of them, the support at tradeats.com is always available for you to send over trades or technical problems. Anyways, all of that being said, I'm going to go ahead and hand it over to Wade. And Wade, take it away.
All right, thank you, Shane. I want to welcome everyone to today's webinar. Apologize on the postponement yesterday. Just that we got a lot of stuff going on, and anyway, sometimes we can't get everything fit in. But I want to welcome you guys. We got people all over the world on, and I appreciate some of you guys that are up late and or up early, depending on where you're located. Appreciate you guys making an effort to be on. So anyway, just want to give you guys a little shout out. Like Shane said, this is not for you guys that are new on these webinars. This isn't a place to try to learn as far as the how to install software, how to change the technicals of the actual software. If you guys need help with that, or you're still trying to get set up, if you're brand new, then make sure you utilize the support at tradeats.com email, and we'll help you offline. What we're primarily trying to do on these webinars is make sure that you guys understand the concepts behind the software and what you're looking for as a basis to get started, and understand, basically put meaning to what you're looking at on the screen. So we're covering basic things. Also, if you have questions regarding certain market conditions, market setups that you're looking at, that's really what we like to delve into, and explain them to you. Because one thing that we want is that when you guys explain what you're looking at, and how you see it, it allows us to give you feedback to bounce off of you, to say, well, you're looking at it good this way, but you may want to take a look at it this way as well, and weigh out the different possibilities that could happen in that market. So that's really what we what we want to do, is we want to get you guys to think about the setups and come up with different ways that you're going to interact with those setups, and basically tailor your strategy around what the market is handing out. So that's what we just want to get you guys to see that. We want you to see the map that is ATS. We want you to see it and use it as a guide to give you your game plan for a particular setup that you're looking at. So that being said, Shane did. Sorry, hold on. Might have a technical issue here. Can everyone hear me okay? Can you guys just type in a Y real quick? I just want to double check before I start getting long-winded. I think it's working. All right. So anyway, Shane did mention that we do have some cool things that we have a lot of cool stuff we're working on. That's probably, honestly, the biggest problem, is that we got too many cool things to work on, and we don't know which one that we want to put more effort into. And we don't have a gigantic team at Trade ATS. It's basically me, Shane. We have a couple people that help us, and a coding team that I work with, and that's it. We're not some huge organization. So it definitely sometimes takes a little longer to get things out when we want to release a software update or want to do something. There's a lot of testing, a lot of stuff that goes into that, to make sure that it works. And even so, there could be some weird situations where people have different operating system setups and things like that that can cause cause little tiny minor difference or difficulties with their particular installation. So we even learn stuff that we don't catch that we have to go back and work on. So anyway, it's we do want to get stuff out to you. We have a lot of cool stuff we're working on, but we want to make sure it's thoroughly tested as much as we can before we put it out there. So there's no kind of like glitches or things wrong, that could happen that way. So anyway, let me get my screen up so you guys can actually see something. That would be helpful. Hang on. All right, so you should be able to see my screen now. So one of the things that we've been working on is it's something to help us understand, basically look at a set of data and understand the normals of the market. If you guys have ever understood or read into Wall Street and how basically the models of how they calculate the trades they want to take and understanding the overall market, they use what's called quantitative analysis, and they'll have people in the office, they call them quants. And what quants do is quants basically sit around and work up models of, well, they do a number of things, but one of the things that they do is they work up models that basically encapsulate the general behavior of the market, of whatever market they're specializing in. If they have traders and market makers working, let's say, for instance, the gold market, they're going to have quants that basically come up with models. They're constantly modeling the gold market to understand the normals of what it does. So what they will have is there's a calculation called value at risk. That is something that they can look at basically the portfolio positions for the market makers that are running that asset class or that instrument, and they know that the value at risk number according to their quantitative model is this X amount of money. And what that means is that they have calculated a way that the markets, let's say, for instance, here's a real basic example. A real basic example for one quantitative model is to just look at a daily chart, okay? And you guys maybe have actually done this. Look at a daily chart, you measure, go back, say, 3 months, and you measure the high to the low of every single daily range, okay? 1 day price action. And then with that, you write down all those numbers. And then in those numbers, you're gonna have one, let's say one daily range is 200 pips. Okay, that's like the biggest, right? In the last, let's say, like I said, 3 months, you're going off that data. And then the smallest daily range is, let's say, 30 pips. Okay, so what you're gonna know is you had a daily range of 200 pips is the biggest one you could find, and the smallest one you could find was 30 pips. The average is gonna be in the middle of those two numbers, right? That's gonna be your average range. So a simple quantitative model is going to help you understand that if you just know in your head while you're trading that, look, the biggest movement this market has had in 1 day period over the last 3 months is 200 pips. So you know that if you're halfway through the London session coming into New York, and the market has had a range of 30 pips so far, you know that that's a very low end high to low based on your basic quantitative model of understanding the daily ranges of the last 3 months. So you know that if there's a setup and you see something possible, we all expect a trend. We want the market to move in some direction. That's the safest movement in the market. So if you know you've only moved 30 pips, you know that based on the last 3 months, that's one of the smallest ranges that you haven't even exceeded the smallest. You know that there's probably, based on the average, that we probably at least get to around 45 or 50, or 100 pips for the move. You know that the high end, now let's talk about the opposite of that. You know the high end of that move, if you wake up or you get on the screen and you see a snap that's 250 pips, you know that that's way above the normals. So are you going to get in and get excited like, oh, let's move 250 pips and you just get in and start going nuts? No, because you, based on your quantitative model, your basic quantitative model, you understand for the last 3 months, this is abnormal. This is totally abnormal, and you're going to sit out because it's outside of the realm of the average swings that are expected. So that being said, that's an example of a basic quantitative model. And with ATS, what we're moving towards, besides having having meaning and a stable platform, is we're trying to not only map the market, but we want to map the normals that are associated with current price action, so that if you're in a trade, what we want to do is kind of like the scenario I just said, is if the market's moved 200 pips and it's way out of normals, we want you guys to recognize that so you can understand that, okay, this is either a new normal, this is going to be the new, and the market's going to start opening up, or this is something abnormal. Let's say, for instance, tsunami hit, like it hit in Asian countries, and those currencies get affected by that kind of stuff, and it can happen out of the blue. So on the screen, we want to understand when something is an anomaly, so that we can basically mostly just sit out of the market and not get caught where it just keeps running away and running away and running away on us. And going back to what I was talking about, the quantitative models that the banks use, they have that value at risk number that they know based on their normals of calculation, that the worst case scenario, this is the most that they'll lose based on the markets going crazy. If someone drops a nuclear bomb somewhere, okay? So they know that all positions will have to be closed based on this risk factor when it gets to this, because that's way out of what they would allow it swing and try to manage that position. It just doesn't, the business is changing on a significant level. So hopefully that kind of you guys understand what that is, and what we're trying to go towards is giving you guys more tools that where you can accurately take the temperature of the market, and understand, is this normal? Is it below average? Is it above average? Are we still in the middle? And that'll help you guys understand the aggressiveness that you would attack the market. So one of the tools that we've been working on, and it's not quite done yet, it still has a few little glitches that I'm trying to get sorted out. But what we have is this new little deal right here. And what this is called is, it's called the expansion index. And what the expansion index does is it looks at a class of data across a number of expansions, and it gives us normals. It tells us when we get out of normal, it tells us when we're in normal, and it does have a look back data, which we're trying to figure out. That's the one thing, is that there is a minor setting. It's not a setting like a moving average or anything where it's going to be tailored to one day, but we're trying to decide how much data is necessary to get an accurate value to go off of. So it's really a question of how far do we have it look back to give us an accurate projection. All the projections are very accurate, but we're just trying to come up with what's the best way to approach that. But in a nutshell, what you can see right here is that every single time we get a new white dot, you're going to get a white dot down here on the expansion index, and then it's going to track the movement that we move away. Let's try to make this a little bigger for you. It's going to track the movement, the actual pip movement, point movement away from that expansion level, and it's going to tell you if it's normal or not. For instance, we had all these movements in here, and you can see that these all were not exceeding these red and green lines. These are average. Those are those average numbers. Like I said, if you took the smallest daily range and the highest daily range, that's not how this is calculated, but similar, you know that you're not even exceeding averages in this situation. So if you're in moves in here, a lot of these moves, if you don't get out of those averages, they're just going to revert right back to the mean. They're just going to come right back to average price if you're not even going through the average. So, and then when you get above the average, that starts to tell you a more significant story. So there's a lot of cool information that's coming out of this. Like I said, we're still working on it and testing it. But there's I think it's going to be significant, to say the least. But anyway, let me see if there's anything else I could think about that I can share with you about this. Again, here's a move out here. We came out of this, and these bars, I will tell you, they build as we deviate away from expansion. So once they start getting above or below, then this bar doesn't just show up this way. If it did, that would have predicted this whole move. That's not what it's doing. That what this does is, as this move developed right here, and we started to get above average right here, that starts to tell you, okay, this thing could possibly trend. So in a situation like that, when you get below those averages, and you see that we're getting above, that's when in a situation, if you get a chance to enter on this, you know that, okay, there's a good chance we could trend in that direction. But you also want to pair it with the higher time frames and things like that. So like I said, we're going to come out with a whole tutorial based on the best way to use this and look at it. We're seeing a bunch of crazy things with it. Even one of the things we're noticing, which is a whole new data set that we never actually had before or in this view, is that there's a lot of relevance to if you guys have ever looked at the IG client sentiment index, which is essentially IG's, the broker IG, it's all their clients and customers. It tells you whether they're net long or net short on any given instrument. And if you're a contrarian trader, essentially we're trying to trade against everyone else. That's what we're doing. Everything we do is contrarian, but in trend with a higher time frame, the short-term contrarian for entry. So what we're seeing is that basically what people use the IG client sentiment index for is that when the markets get what they say overbought or oversold, basically there's no one else in the market to go long or go short. You go the opposite direction, and we're starting to see that there's relevance with that. As you can see, like in a situation like this market pulled the market down, and then you can see the average move, and you can see the average on the other side shrink. And what we're seeing is that this is almost predictive of the coming counter trend move, when we can see based on the whole market, not just IG's clients, we see everything when it's truly, I don't like to use this word overbought or oversold. I think it's kind of dumb, but for lack of a better term, so everyone can understand it, overbought, oversold. We're starting to get data that is significant in that way, where we can really see where there's too many people in the market. For instance, right here, we had this bar push over average, and you can see that the average was bigger on the long side and shorter on this side, and that was predictive way before. We're talking back in this neighborhood, before the possibility of this big move down. So there's some really cool data coming from this, and we're excited about it. Anyway, that's probably all I could share with you about it right at the moment. Look forward to letting you guys have this. As you guys know, when you are subscribed to ATS, we're not proponents of here's our next big trick, and if you really want the good stuff, it's going to cost you this. I don't care about that. If we have something good and you guys are subscribed, like, we're just gonna we're gonna give it to you when it comes down to the basic ATS software. So that you guys don't have to worry about being upsold. You don't have to worry about any of that kind of stuff. If it's based on the basic framework of ATS and it helps you guys, like, our goal is to give you guys tools and have you guys be with us forever. That's our goal. Not to make a ton of money off someone selling them a $5,000 subscription when they may not have a good chance of being a successful trader at all. We don't want to be like everybody else. We want to give you helpful, useful things at a very, what I think is a very fair price. And the test of time will be how long you guys stay if you find the tools useful. I think they're super useful. I mean, I created the algorithms. I've been working on this forever, but some people do not find, they just can't get their head around it, and that's perfectly fine. But for you guys that do find it useful, if we have something good, we're working on something, we want, like I said, our goal is long-term relationships. And we don't want everyone under the sun on our platform. We only want the people that really find the value with it, and that will, be with us for the long term. And we know that if we're going to create value, we have to make sure that we give you guys the best stuff based on drilling down this methodology. So anyway, this is a cool thing in the works. And that's it. If you guys have any questions, let me go through and see if there's any questions based on this. I can't answer a whole heck of a lot about this, but let me see what's been typed here. Give me one moment. Okay, a question from Mark. I think he's referring to, is it based on the average true range, the ATR? No, I think you probably understand that now. Not, not, this is all based on proprietary calculations of ATS. None of our software it takes any data from any other indicator, including moving averages, including Ishimoku, including ATRs, including oscillators. Nothing on this screen is based on what anyone else is looking at, as far as another indicator form. So hang on real quick. I'm still doing some reading here. Okay, good question from Bo. Let me see here. So does that mean you should consider a trade back into the average if you're staying within the ATS average, and start consider a new trend once you break out of the average? Yeah, what the averages, I can answer that right now. What the averages are going to do is it's giving you normals. Let's say, for instance, that you catch, let's say on dollar CAD, you caught this move out of here, and let's say it's in line with your 4 hours coming around, and let's say you caught it maybe on this rotation right here. If you're going to trade under average price, I will tell you that these trades, they need to take off right away, as far as managing risk, because we're trying to usually get it above or below. But if you think momentum's hitting, you can get in at the turn, but you need to make sure they're going to get you in the money right away. But let's say, for instance, that you did get it on the rotation right here. You felt good about a prevailing downtrend. The minute you got below this, what that's telling you is that we're breaking out of those normals. So at that point, you can start to make decisions and understand this is just another gauge. It's another gauge to tell you if the market is speeding or not. It's telling you what's the possibilities here. And then all these moves that aren't really exceeding the average, you can see that's just noise. So what the idea is that if you guys see a potential setup and you feel like, oh, this looks really good, and you get in, ultimately, I mean, we all want to be in moves like this right here. This is what we're ultimately looking for. The problem is that the markets do a lot of this. And so we want to constantly check the temperature of the market. And you can get in, because the entries on ATS are designed in a we're trying to do a counter trend entry into a major trend. You'll understand that if it's starting to take off and you get below or above average price for profit, but it doesn't take off, you'll see that reflected down here in the normals. And so you won't be just looking at just the price action, hoping that it's coming. You can look at not only the initial expansion and what the normal is and where it's ranking, but you can look at the overall data set that you have going on and check that overall temperature. So the biggest thing is it should be used for would be just to understand when you pull a trade, you're going to understand whether you're meeting or exceeding normals. And that's going to help you make the decisions that need to be made as that trade unfolds. Hopefully that kind of makes sense. Okay, let me keep going through some questions here. Bill, that's awesome, man. You sound Bill's doing. I won't tell everyone what your business is, but you're doing a good job, man. I'm glad you're liking it. Okay, good question. How long until this is available? I'm waiting on an update for my coders right now. Honestly, I should have had it like a week ago. That's just kind of how these things go. So I'll tell you the process is I draw when I do a new piece of code, I literally draw out schematics for the entire thing. Everything that I can think of that should be included, I send it to my coders. Then they send me back the first version, which is usually I get it and I'm like, okay, this isn't what it's usually not right. So I have to go back. It's a good stab at it, but I'm like, okay, we need to adjust this. We need to do that. This can't happen that way. And so I have to go through kind of a learning process with the formula. And sometimes I can go back and forth several times before we get something that is, number one, not glitchy. A lot of code is glitchy at first because you don't foresee the minor differences in the calculations that can throw things off. So a lot of those things have to be sorted out. So anyway, long story short, I'm on, well, right now this is the third, you see ATS expansion index 3. This is the third version that I've been testing. It's about there. There's a few things that need to be tweaked. But normally on something like this, I would hope that I wouldn't go more than 5 versions before we nail it. So anyway, we'll see what happens, but I'm just waiting on the next one. If it's good to go, and I can confirm that it's at least good enough, we're at a 95%, then we'll probably release it. And I'm hoping that we could do that probably in the next like 30 days or so. But anyway, hopefully the next month. That was the long way around your question. 30 days or so is what we're hoping for. Okay, hold on, let me catch up on some reading. Okay, question, I think it's a general trading question. I'll answer it real quick from Benjamin. Happened that I have a position open and suddenly I'm inside the box. What should I do? It depends on what you're expecting. If you guys are in trades where you are expecting, you're trading in trend, you open a position and boom, now say the 15-minute goes into a box. A few things you need to look at. Number one, are you at break even or how are you in the money? If you're in the money, that buys you more opportunity to, you've basically got more of the, for lack of a better term, house money to play with. You can decide to stay in that box. Number two, if you feel strongly about the direction, then you can expect that you can basically, if you're in a box and let's say you entered on the short side, you sold the market, now you're in a box, you can decide that you're going to stay in while you're in the box, but you're only going to let it break short. If it breaks long, you're out. So that also depends on where you're at. A lot of times though, if you're at break even, depending on the market environment, sometimes a good thing to do is just close the trade. Close a trade, wait till you break out of the box, go into expansion, see how it treats average price, and then make a decision. That's usually the best thing. Now, if you're in a trade and you're up 50 or 100 pips and you go into a box, again, you got a lot of house money to play with. You can make all kinds of decisions if you want to ride it through the next day. You can look at the daily, weekly trends. Like let's say you caught something like this and you let it ride and now you're sitting up. You can now look at the daily, the weekly chart and decide if you think there's a major rotation happening, you're up significantly. Chances are you're not going to get manipulated out of this position within, overnight. Now, if you're trading somewhere like in a range like this, and let's say you start to get out of session and then you go into a box, chances are you're going to be negative on that position. Markets usually go sideways out of session anyway. So don't even put yourself through it. Just close a trade at break even, come back when there's fuel in the market. We need volume for it to move. Just come back at that point. Okay, let me catch up here. So, okay, talking about examples with the new indicator, yeah, that's part of, when we release it, we're going to release tutorials and all that stuff based on, how to read the gauge. There's a lot of interesting ways to use this that we're seeing. So, you guys may even find your own interesting ways to see it. For instance, there's for lack of a better term, pattern that we're noticing that you can see that the general expansion even represented in the bars. So for instance, when you break below the last one, you can almost see a reversal happening if it doesn't, especially if it doesn't get out of the normals. You see that this red bar was below here. We didn't even have a red bar. And you see the next one came above, the next one came below. So you can see when the bar meets or exceeds the previous bars or set of bars, you can see that if you're not significantly above normals, you're coming right back into that range. There may be, a strategy that's just trading back towards the mean inside the average based on just more volume coming in than the previous bar. So um, again, that's totally different than we want you to stay in trend, because that's the safest way to approach the markets, regardless of using ATS or not. You need to trade in trend. But there are some really cool things based on the data that this gives. So, but we'll come out with tutorials and all that based on what we think is safe for someone to start. We don't want you guys getting overwhelmed with a bunch of different signals and different things to think about. The part of the way you're going to be successful is keeping things very, very basic, and understanding your entry into trend. That's really where it starts, and then the rest is just kind of icing on the cake. Okay. Hey, you guys are chatty this morning. Hang on, let me catch up here. Okay, good question. Talking about the exiting a trade. These are always the biggest questions. How do I enter? How do I exit the market? That's always, it's going to come down to a certain level of finesse. What ATS is trying to do is trying to accurately define a trend on the higher time frame, and it's trying to give you a safe general range to enter the market to get you in the money. That's it. That's kind of basically the best we can do. How long you stay in comes down to finesse and understanding where your higher time frames are headed. In a situation like this, if you catch a trade like this using the new index, what you could a decision, remember, these are just decisions. Sometimes they'll be right, sometimes they'll be half right, sometimes they'll be wrong. That's just the way it goes. But when you get into situations where you do have the ability to let it ride, one of the questions is a good way to exit the market just to look for a different color on the Heiken Ashi candle. Like for instance, if you were short here, this turns green. That's a very specific signal. If you're up this big, and right now we're coming out of session, so if you're in this and you don't want to hold it, yeah, right now is the next time you see green, market's probably going to go flat right here at this level. So it probably doesn't have too much more juice in it. So yeah, that'd be a good place to cover, but it's going to depend on the timing and things of what you expect out of that market. One thing with the expansion index is if you do catch a trade like this, or let's say one like this where we came out of normals right here, you see that we came down out of normals. Well, you can wait till you just get a new box if you really hook a big winner. So, I mean, you could just stay until it goes back into contraction. It's also dependent on your time frames and things. If you're trading a 5-minute chart, you're going to get a lot more price action to deal with. So you really just have to weigh it out with that specific situation, and understand what the normals are. If the normals of the day, going back to the expansion index, you're going to know relatively quickly if it's going to be kind of an average range day. And you're going to know pretty quickly if you're above average and it's going to be a significantly trending day. You're going to get those indications pretty quickly. So part of the understanding when to enter and when to exit is to be able to have an accurate view of the day that you're dealing with. If you guys know that most days, we have a 30, or a 40 pip range in a given currency, that that's kind of the average swing, and you'll be able to see that reflected in the expansion index. And if we're not getting any significant pushes, and let's say that It's when New York has opened, we get the initial opening move if there is one, and nothing's really happening. You're probably going to stay inside that range, but I mean, it doesn't have to happen, but you just know based on the time allotted for the session movement, you'll be able to make those accurate calls. And that's a lot of this is understanding the nature of the beast you're dealing with and treating it accordingly. And that's really what we're trying to get to with that. So exiting the market and things, that's mostly going to come down to what the day has shown, your position in the day according to how you traded it, and what that has allotted you to do. If you're up significantly on a trade, then that buys you a lot more decision-making power to see where it goes. If you've been battling through the day and you're maybe down a little bit or at a break even, by our time, by like 8:30, 9 a.m., we're hanging it up. It's just not gonna, basically end in New York. It's over. So just depends on what you're trying to do. Okay, question, any idea about currency correlation? I don't know if you're referring to the expansion index or just in general. There's definitely correlation between currencies. We don't really get heavy into that. We're usually trading one pair, at a time, maybe monitoring 2, maybe 3 pairs if you're really have a lot of time on your hands to do that, but mostly just one pair, and we're looking at the technicals. All of the fundamentals and all of the everything that knows, everybody that knows anything, including insiders and everything, is going to be reflected in the price action at the end of the day. It's going to be reflected in the higher time frames. The bigger banks that move the market, they don't move it on a 1-minute chart. They move it on a weekly, monthly, daily charts, depending on the size of the amount of money they're trying to move. And it just depends on available liquidity to do that. So all your fundamentals, all those are going to be reflected in your higher time frame charts, and that's the importance of using those as your directional bias. So looking at different correlations to try to predict trends and things like that, we don't get heavy into that. We try to stay in real time and become specialists in the asset class that you're dealing with or the currency pair that you're dealing with. You want to specialize in a market. If you trade dollar CAD, you want to be the king or the queen of dollar CAD. You want to know everything about the movement. You want to understand the general ranges, just like the expansion index, and you want to understand the normals. You want to understand the pulse of that market. And if you're looking at too many pairs or trying to check correlations, you're spread so thin with your attention that you can never really master the movement of one pair. And I understand that pairs do go sideways. I do understand they get stagnant at points. But remember, just about the time that a pair gets stagnant, it's probably in contraction on a higher time frame, and that means it's about to open up. So if you just kind of live and die through one pair, you will be there for the sideways markets, and in that point you can take the gas off and trade them lighter. But when they start to open up, especially on the higher time frames, that's where you start putting the pedal down a little bit more, and then you will be there for those trends. And because you're so in tune with that pair, you'll be able to feel it. You almost develop somewhat of an intuitive sense, and that's something that can never happen if you're focusing on so many different things. Become a specialist just in that one or maybe 2 markets. That's it. Same thing with the ATS assistant. Some of you guys ask, how many pairs can I run this on? And that's definitely the wrong question to be asking. The question is, how can this ATS assistant help me master my pair? How can it make sure that I don't miss an opportunity or a possibility in my pair that I'm specializing in? That's what it's more about, so that I don't have to sit there and watch dollar CAD my whole life, but I'm going to be in tune with the higher time frame setups. I'm going to be in tune with the lower time frame setups, and I'm going to know the pair inside and out. That's really what it's designed for. Okay, let me keep reading, guys. Hang on. Okay, good question from Ishmael. What does it mean when the averages widen on the expansion index? What it means is that the averages are widening. It means that we're starting to get some more movement in there, and it's giving a new a new reach as far as a new normal within that data set. So that's just what it means. Just a new goal to push to. For instance, if you look at this one right here, we had this expansion right here, and that pushed up the average. So then these following expansions were still within that because this defined a new average. And then when we finally had that breakout, you can see that it just crushed that average, and that raised the whole average as a whole. But now we have such a huge average expansion here that none of these following expansions could touch it. There's just too much money on the long side. So you see they're all just in it. So if you're trading that trend, if you expect, like, let's just say that you were trading this, you saw this market spike, and now you're trying to pull these entries like under expansion here. Let's say you're long here or you're long here, and then you're getting above. You know, the minute you get above like an expansion right here, that means you're in this one. You got to reach up to here to get, you know, to continue above normal, and that's, you know, may not be likely based on what's going on. So what can end up happening by looking at this and you sticking your entry, and then you get into the profit zone, now you can start to see, okay, it's showtime. It's either going to perform or it's not, and you have that data set to understand it's either going to go or I'm going to bail. And you just, instead of letting it come against you and take away all your profit and getting married to a trade, you can see that it's not performing. You take it from the turn here, get out up here, you know, or give it time to perform. You probably get out right here as it turns down, take maybe a small profit, but you understand the market environment. You know, we can't control when the market moves, how much it moves. We can't control any of that. All we can control is the opportunities we expose ourselves to, and then how we manage those opportunities. And so the more accurate of a gauge, the more accurate we could tell the temperature of the market, the faster we can do that, the faster we can get to information, the better off we're going to be. So, okay, let me keep reading here. Hang on. Thomas, oh, okay, never mind. I see that Shane got you to there. Okay, never mind. Sorry. Yeah, if you guys have, like, again, if you have gotten on since we started, if you guys, anyone new that has any technical support type issue or something, make sure that you guys just email support@tradeats.com or fill out the technical support request form is the ideal way to do that. Those get answered usually first because that's the avenue for that. So if you guys can just keep them going to that'd be great. Okay, question, do we use volume? I'm assuming you're talking about tick volume, since we can't really see who's on the other side of the trade, like stocks or equities. So you're talking about using volume. There is some minor correlations. We actually had back in the very first run of ATS. I'll have to dig up a picture of it. I think Shane actually has a picture of it. I'm sure I do somewhere, but we had one of the pieces of code that I wrote a long time ago was called activity candles, and they were volume-based color changing. They gave a heat map inside of a candle, and we did use that for a long time as to help correlate basically intensity in the market. It was actually pretty cool. I tried actually to recreate it on MetaTrader, but the way MetaTrader works is the very first version of this was built on FXCM Trading Station, and that for any of you code junkies, FX Trading Station uses Lua code, which is actually a code that they use to program video games, believe it or not, and like home automation systems, they use it for that and stuff. But we were able to do some cool stuff on Trading Station, especially visually. It's a really awesome visual you can create on FXCM Trading Station, but we couldn't translate some of those cool things onto MetaTrader 4. And the only reason I ended up leaving Trading Station was because FXCM got banned in the United States for a number of reasons. They just had went through a bunch of problems. They got bought out by Gain Capital, and basically just a lot of our U.S. traders were uncertain about trading with FXCM, and it just kind of, the whole thing. Anyway, that's why I recreated on MetaTrader. So anyway, that's a long story. I got a lot of stories, so I apologize. Going back to, we had the volume correlation on the candle, but I couldn't translate it into MetaQuotes language the way I wanted to. But we may do something in the future. There is some correlation with volumes coming in. I will tell you though, what you have on the screen right now, just looking at the color change of the candles, understanding the expansions, the average price, understanding those things is all you need. You don't need to complicate it past that, but if we can do something in the future with the volume and tying that in, and it's helpful. The one thing that we look at is it may be slightly helpful, but if the confusion factor we think is too great, we won't do it. It has to be extremely helpful. If it's not extremely helpful, it gets deleted. And that's kind of the criteria based on anything that we would want to look at ourselves or anything that we would give to you guys. If we don't see like people are going to get this, if I don't think you're going to get this on your screen and be like, wow, this is amazing. Like, I can't believe that something like this was developed. If I don't get that sense, I'm not going to give it to you. That's why I really try to operate under those parameters. Okay. I'm sorry guys, I'm a slow reader. Another quick question: does the green or red bars on the expansion index, do they present themselves before the price action move? No, I wish. Yeah, it's talking about like, does this appear this way before? So no, it builds in time. So you're going to have to see as you get above average. If you're in a trade, all trades will start within the average. When you get a new or all expansions will start within the new average. So it's something that you have to progressively watch it build and make decisions in real time with it. And then once you get above or below the average, you'll know that I'm above or below average. These are the possibilities. But yeah, it doesn't. I wish it had that kind of predictive quality. That'd be that'd be pretty crazy. Okay, we're going to get into some markets here in a minute. So I'll take a look at euro dollar. Let me see if there's any more questions I can answer about this here. Okay, good question. The question is understanding like basically the risk to reward ratio on based on the basic strategy. Excuse me, entering in trend above or below expansion on your lower time frame. The trades are not going to. Well, let's just put it this way: the farther you stretch from expansion on your entry, basically the more pips you're going to have coming back to that expansion as an initial mean reversion. So you can, based on where you pull the trigger, you can see how far you're deviated, and you can come up with some calculations based on, where you expect to at least get to. Really, what we're trying to do is we're trying to hook a trade, hold above or below the target expansion line on our entry, and then ride it into some sort of trend. So the initial risk and reward is, it could be sometimes 1-to-1, or if you wait for a good deviation, it could be better than that. But really what we're in the game for is we're in the game to trade the higher time frame. Remember that the lower time frame is a tool for entry. It's a tool to enter the higher time frame based on timing and based on expanding. When you see a 15-minute in contraction in a box and you see a trending 4-hour time frame, clearly trending, or if you're trading the 15 in the daily, you see a clearly trending daily time frame. What we're doing is that when we're in that expansion on that 15-minute, we're labeling that box with a bias. We're expecting that that 4-hour and that daily is going to move and exceed the next candle, whether up or down. So when you get an expansion out of a box on a 15 within a trending cycle on a higher time frame, you're going to initially treat all activity around that box that it's going to wind up expanding downward. So what we're doing is we're timing that expansion with a bias in trend with something that's already moving. So when it comes down to risk reward and things like that, what we're really trying to do is we're trying to hook a trend first and foremost, and your ultimate reward should be where you think you're headed on the time on the higher time frame, and the rest of it is just fishing for a decent entry. And even in a sideways market and situations like this, if you should only be trading the one side of the market that's in line with the higher time frame. In a situation like this, we had obviously non-farm payroll come out, and all that stuff go on. So that usually that kind of sets up the market for the following month. So I don't like trading around non-farm payroll because it's setting up the fundamental directions. So usually the week after, you want to trade the 2-3 weeks after that, and then the week leading up to non-farm payroll. Good rule of thumb, just my opinion, don't have to do it, but is to kind of scale back a little bit. But you want to have faith in your higher time frame. If you don't feel like your higher time frame has the potential to trend, then you really want to be careful on your entries regardless. Because at the end of the day, we're trying to hook safe entries, maybe with a one-to-one risk reward possibility coming back to your initial target average price on your lower time frame. But the real what we're in it for is to finally land in something like this, maybe once, twice a week. That's it. That's really where it comes down to. And by having such a tight entry system and a tight expectation, the idea being that you do have the possibility once you get better that you can up your leverage if you feel comfortable, and you can make the most out of being in momentum. The only way to trade, basically the rule of thumb is the higher leverage that you trade, the quicker you need to be in the money. And so that what we're trying to do is we're trying to get you a methodology where you're in the money quick, and so that buys you the choices to stay in the trend and hold in and wait till it breaks, but you're already in the money. You have a strong entry. Whereas a lot of the population, the trader population, they're entering when they see this coming down, they're jumping in down here. They just can't wait. They're missing it, and they have the fear of missing out. They're jumping in. And that's a weak trading position. In some cases, it'll work out. If it's a significant break, they'll get in. But overall, when the market goes back in this sideways movement, they're going to get crushed trading like that. So we're always trying to trade from a point of view that we're trying to get a strong position to enter a move that's already happening. So like I said, going back to the question, what may start out as not the great of a risk to reward based on just getting in the money, it may a lot of times be a one-to-one. But your real trade is your higher time frame. So you're expecting that trend is going to kick in at some point. You're going to hold above or below your target expansion for your entry, and then you're going to be in a big winner. That's really what we're looking to do. Okay, hang on, guys. I'm catching up. We're going to probably wrap it up here pretty soon. We'll try to keep these things around an hour, but we'll get into more, see if we could look at a couple of markets here. Okay, another question from David. What do the numbers on the right of the normals chart represent? So what he's talking about right here is this is the amount of pips or points, depending on the market you're looking at. That's basically the deviation. So we know that this market, let's see here. So from expansion, right now, the average is 280 pips. And right now we're deviated 519. That's a current number to our bid price right here. So what it's going to tell you is this is where you're at. This is the normal. This is what can be expected. And this is what can be expected on the short side. So it's just giving you those gauges, and you can see if you're in a short move, for instance, let's say you were trying to still trade this long right here, then you would have had that number read out. It would have been over here reading 467.89 roughly. So you would have realized that there's a possible 400 and something pip move to the upside, or point move. So it's again just giving you a readout. It's a gauge, just like a car. It's telling you, how fast you're going, and you're going to have some idea of what the normals are, and then also, where we're currently at. So. Okay, hang on, guys. Okay, question about sticking with the same, which pairs to trade. All pairs are they're gonna go through cycles of volatile cycles and not so volatile cycles. Let's say that you are the easy question to that is, I mean, unless it's some market that has some fundamentally just okay, for instance, penny stocks. Okay, the only way penny stocks ever move is if a promoter pumps them. I'm talking about like unknown companies that basically the shares don't move because nobody hardly knows about them. But when a promotion goes out from the promoters to their email lists and they start promoting it, the stock will start to pump. And then the promoters will eventually dump their stock. It's called classic pump and dump, right? So in an asset class like that, the volatility is thrown off. So that there's fundamentally a wrong just model in that market. You need something that is swinging, something that constantly has volume, to really trade. So that the basic answer to that question is, you would want it, whether it's typically you're not going to have that with currencies, but if it's just known for being really, really like an exotic currency or something that just moves weird, that's not probably something you really want to focus on. You want to focus on something that has a lot of active traders. Mostly the Forex majors are, if you're trading Forex, just stick with the majors. Even if you're going to trade euro, dollar, dollar CAD, or it could be commodities. Oil's a little weird, but like gold has been a great market. So it doesn't really matter. As long as it's heavily traded, it will go through its cycles of it's moving not that great and it's moving huge. There was a consolidation in euro dollar in late 2011. And when we were trading that, I remember we were talking, one of the guys I was trading with, we were like, it's almost like going into nothing. Like the volume is so low. We're like, it's almost like people are quitting trading. And I was less experienced, obviously, at this point. But that we just never went through a cycle where it tightened up so much, especially on the higher time frames. But then shortly after that, euro exploded, and there was great trading. So when it goes to understanding what you want to specialize in, a good rule of thumb is just stick with something that has traders actively involved, something that's more of a major. I'm not a too big fan of the exotics, but just your major currency pairs, connected to the euro, connected to even the yen, the pound, dollar, obviously, and just stick with them, and they will no doubt have some sideways periods, but they will no doubt have some big swings, and you'll be there for all of it. The key is on the big swings. When you have the perfect hand, you go heavy. That's really what it's about. Nothing more frustrating than watching a bunch of markets seeing something starts to move, jumping in on it, it starts going sideways, you maybe take some losses, and then it goes into a sideways movement, you get out, go find something else that's moving, that then starts going sideways, and then the market you were trading before then starts moving again. If you have a consistent approach to the market you're specializing in, then that is an edge in itself, because you're just so consistently there. You're going to be there better than everyone else that is scanning all their pairs. Everyone that's watching a bunch of pairs today sees this run on CAD, and if they're looking at a bunch, they're not paying attention to just the CAD. The chances of them getting this at the top, before it came down and held below that expansion, is probably not going to happen. But you're going to have a bunch of traders who are storm watching jumping in now. They're going to feel like this is the new shiny object that they want to trade, and it's probably going to start going sideways. And they're going to get beat up. So you want to be there for the contractions. You want to be there through the expansions into the trend. That's where you do it. That's where you want to go a little heavier. But anyway, yeah, just stick to the majors. Okay. Okay, Mark, I see your question. I think I probably just answered your question with as far as the approach and how many pairs looking to trade. Like I say, you guys can do everything you want. I got guys that have been trading a long time, some of them longer than me, and they have an approach that works for them. They integrate ATS into what they do because it gives them good information, stable platform. Again, it's a benefit of ATS. Same information every day, no repainting. It is what it is. And they're able to scan more markets. Because they've always done it and they've learned how to weight it. And if you're one of those people, by all means, go for it. I'm just giving you my general opinions based on, what I think that focusing down on one or two, I think there's an edge in that personally. But if you are used to doing something different, then, by all means, go for it. Okay, we'll take a look at Aussie NZD. If I could find it, that would be nice. There it is. One thing I'm trying to work on too is the load time, because all of our ATS software and everything is super data heavy. So one thing with tracking all these levels and everything is it doesn't load up quite as fast as a moving average. Let's just put it that way. So that's Aussie NZD. I just had someone ask if I could just throw that up and they could take a look at it. There you go. Okay, a lot of people looks like they're requesting just want to see the expansion index on different pairs, so I just want to see it on euro dollar. Like I said, it's not 100% done. It's pretty accurate what it's reading. The normals shouldn't change much, but if you're going to go rip a 10 lot or a 20 lot position off of this right now, then you shouldn't do that. Just a warning. But you guys can check it out. So here's US euro dollar. Okay, cool. Here's a good question. How effective is the daily time frame as a directional bias with a 15-minute chart? The daily time frame, if you're going to be in on the session and out on the session, um, basically, if you're, let's just put it this way, you're going to be liquid by the end of New York. You're not going to be in any trades. You're looking to just basically essentially day trade. And then the daily can definitely be helpful in helping you understand the direction of the day. Longer term swing trading, sometimes the daily can bite you that way. That's why we like to refer to like the 4 hour into the weekly. But the daily can be a decent predictor of which side you should stay on for the day. Maybe even looking at the prior day to see what the trend has been, see how the price action's holding up. You may, in certain situations, want to mediate those between the 15, have a 4 hour and a daily. I know the 4 hour and the daily are a little close, but when you marry those two time frames together, it will show you, it'll give you a better sense of momentum. Whether like if the daily's charging and then the 4 hour aligns with it, then that'll show you that the next 4 hour candle has a good chance of surpassing the current 4 hour candle or the last 4 hour candle. So you can marry those two together for a momentum sense. But trading the 15 into the daily alone, again, the daily help you understand what side of the market you should be on for the day. But if you're looking for the daily to rotate against you to get out, that could be a little dangerous. It's kind of because there's a pretty big difference between those. So you could do it, but you really got to have. I know some of you guys just getting started. You're looking at your higher time frame to rotate against you to get out. But you really want to get past that. That's a fine place to start as you're learning, but you really want to get past that when you see that we're not meeting or exceeding. The same thing with the expansion index. When you see that you're not exceeding normals, then you're gonna have a good time. It's sometimes a good time just to get out of the trade, depending on where you're at. And traders that have traded a long time, they don't probably even need to look at this because they intuitively do it. They understand if a trade's acting right or not, just because of an intuitive sense they've built up over time. So we're trying to do that for you guys that are newer to trading. We're trying to give you tools that build intuition. That's essentially, besides being a stable platform, that's what ATS is trying to do. It's giving you a tool that builds intuition to the market and helps you not only be creative, but helps you flow with the market in a way that where you can just make decisions, not based on waiting for this is my exit signal, this is my entry signal. You do have to have a systematic approach to the market in general, but you have to be at the same time flexible enough to understand, what the allowances that you give that system. Everybody that has a mechanical system has some override button, and they're always going back and forth in their mind. Like, do I override my system based on what I know, or do I just let the system do it? That's the battle. We're trying to kind of take the best of both worlds out of that. And so you have a systematic approach of going towards the trend of the market, which is everybody knows you trade with the trend, and that's a given. And by giving you some entry criteria and some things to work with that give you some specifics to start with, but over time will allow you to be more and more creative and in flow with the market. So anyway, I forgot what the initial question was. I go on a lot of rants. I'm sorry guys about that if I get off track sometimes. Bernard, I got a few people on here I think that probably missed the beginning when I introduced the new expansion index. I'm not going to go back over it, but there will be a recording of this webinar uploaded to the online course where we have all the links to see them. It'll be uploaded after, probably later today or beginning of tomorrow, just depending on if we get to it or not. Okay, so I'm going to take a look at pound franc. Okay. Okay, see, this is one of the glitches that I got to work out. Sometimes we get, when we switch pairs, depending on how the data is reading, it'll make it disappear. So let me pull that back out. I don't know if you guys want to see it with. Okay. So let me see here. Pound franc. Okay, general opinions on pound franc. Let's work through it. Monthly. Monthly's long. At expansion, so it may rotate off that, but for all purposes, you're long. Okay. Weekly. Weekly's long with the monthly. Obviously, we're pushing. One thing I notice on the weekly, which we're not there yet, and this is a weekly chart, so this could take 3 weeks to transpire or more. But yeah, I would watch if you are long and holding a weekly position. I would watch when you get up to this level to possibly look to cover if you're just riding this weekly, because you will probably get a reaction in this general range around this expansion. So I do notice that we are crawling back up towards that. Daily, let's see what we got for the day. Been crawling up. Yeah, it's the same thing represented on the weekly chart. I wouldn't be surprised if this expansion line's not at a similar price level as a weekly expansion that I was just talking about. Yeah, I think we could be headed up to this level. It looks like it could be crawling. So yeah, you want to be long. Today was a predominantly short day. Well, just from this drop right here. Interesting. So, okay, so and this is all the correlations I'm seeing with the expansion index. Pretty crazy. So we see we dropped right here, and you can see they pulled the averages below, or they pulled the averages to the short side. Well, actually, they were pulled back in this range right here. So we pulled the averages and then really pulled them, and they got a lot of people short. So if you correlate the 15-minute with the daily's still above average price, the weekly's still long. So look what happens when they get everybody on the short side, and then we're not even, getting that average. That shows you there's weakness to the short side. And then next thing you know, look at it's going long. And then the average was not hard to exceed at this point because they got everybody on the short side. So that's kind of interesting stuff that it's pretty crazy. So right now, if someone said you had to do something, I would go long. I wouldn't do anything right this moment because we're coming out of session and it's going to go flat probably. But yeah, you're long. You're long with the weekly. What I would wait for is I'd wait for the daily to rotate and show green again. And the minute that you start getting some green days, I would start getting heavy on the long side. Wouldn't go short though. Let's put it that way. You don't want to trade against that trend. That's for sure. Okay, guys, I'm going to answer a few more questions here. I'm just going to go through. I apologize if I don't get to your questions. We got a lot of people on these webinars, so it's hard to get to everyone's question. And I know Shane's answering some of your guys' questions through the type chat, so that's helping a little bit. But again, if you guys have any questions too, as far as looking at markets and things like that, you can always send in screenshots to TradeATS or support@tradeats.com. And we're more than happy to give you guys a little bit of feedback that way, especially if you're just learning. Like I said, our biggest goal is that you utilize the tool. That's what this is. It's a tool. It's a tool to give you guys a stable platform to build your skill set on top of, You know that every day you come to the screen, you're going to have boxes, expansion lines, liquidity lines. And the more you understand what those mean, the reactions they cause, and the behaviors around them helps you understand how the markets are behaving according to sensitive price data. And so that's our goal, is to get you guys to understand the framework you're dealing with, and the ATS becomes a valuable piece of your own trading puzzle. So. Okay, here's a question. Some training videos you say we want to get in as price leaves and moves away from the expansion lines, but smart money sells above and buys beneath. So why do we want to get in price leaves expansion? Okay, so it's a question from Richard. Good question. What Richard's talking about, let's go to the 4 hour, because I know a lot of you guys are looking at the 4 hour as your gauge for your daily trades. Okay, so 4 hour long on the candle, under expansion, but that's that tilting point. When the 4 hour gets above this expansion, then you'll probably see the daily going green at that point. But going back to the question, you know, right now we have a 4 hour green. So here's kind of a classic entry example. We're below expansion. Now we're getting back up. If you got caught it at the turn or on the wick, you know, somewhere in there, you're getting in the money. So that's the goal of the system, get you in the money, right? So now we're, just say you caught it at the turn, you're starting to barely just get in the money. That's the kind of the safe entry point. Now, what happens when you get a situation like this, where let's say you're long on the 4 hour and now it's above? Can you get in? Can you just jump in? The answer is yes, because you understand the nature of the beast that you're working with. We're going to always point you to get into the counter trend liquidity because it's the safest way to get you in the money. But here's the thing, is that let's say you jump this candle right here. You're still, depending on where you get in, I wouldn't jump it up here on the wick, but if you catch it on the rotation, then you know that the momentum is either going to kick in and traders are going to start piling in on the long side. Market makers are going to start unwinding their bad positions or taking their profits out of the market. And that characteristic of that activity is a trend. So if let's say you buy the market right here, you buy it on the breakout and you see that it's holding above that level, what's your expectation then? Your expectation is a move away. If let's say it fails, it goes back, let's say that you get a pop and next thing you see a red 15-minute candle. Well, your ultimate out for that model, the business model you formed around that trade, it changes at this line. If you come down below this line, guess what? It was nothing more than a back and forth expansion, and now you're getting the information to make that call. If that makes, hopefully that makes sense. So you can trade in momentum. Same thing in a situation like this, where you come up, hold below expansion. You can sell this because especially when you see the activity, but you need to be quick to get out. So your risk on these trades, they're kind of like it either goes or it doesn't. What you don't want to have happen is you don't want to buy the market right here or up here like everyone else and then watch it go back, because remember, their comfort level is this line and ultimately the liquidity line. That's why they're called liquidity lines. That's everybody that jumped this trade and is in, and they're not looking at the architecture that we're looking at. They're all waiting for it to hit a home run on this. And right here, they're going to be forced out of that trade. But we're getting information much, much quicker. So you can jump the trade, but remember, it's a question of information. Is the information going in your favor? If it's not, you're going to know at this line. So the further you get away from that line, understand that you're going to be subject to everything else, or to the same thing as everyone else. You're going to have more and more risk of the market turning against you. And ultimately, you're not, as far as ATS, you're not going to get new information to change your mind down here, because that's really the main point. Now we have a new box, so there's more information here to work with. There's new architecture. But I'm just like, for examples of talking about this prior move, the farther you get away, the more, like if the candle just turns red, and let's say it's just kind of going sideways, and you jumped in, now you're down, you know, you're going to feel uncomfortable because you know that you're not going to be able to confirm anything until you get back down to this pressure point. So it's just something to think about. If you're trading in momentum, just put it this way, you got to be in the money quick. If it doesn't take off, you got to just give it tight allowances and understand that you're now with the trend. I mean, you're with the dumb money, and that's okay because we understand where their breaking point is. We can see where they're going to be forced out, but understand the beast you're dealing with. Okay. All right. I'm going to try to find one more question, and then I think we're going to wrap it up. Quick question about Rick asked, what money management system do we use for our, it's the same thing that everyone is. You don't want to risk more than 1, maybe 2% of your account. And there's nothing ingenious about that. It's actually pretty boring. One thing that I would encourage everyone to do is to understand, because you have a system here that shows you such tight allowances for turning points. The more familiar you get with it, the ability you can use higher leverage in certain situations, and really knock it out of the park and still control your risk, 1 to 2%, just because you are literally at the make or break point. And that's going to come in different forms and on different time frames and different lot sizes and the way that you guys decide to calculate it. But you're looking at something here and spending time understanding a system that gives you those sensitive points. So as you guys will get through, it won't be every day, it may not even be every week, but maybe once a month, there's going to be some price action that happens and some situations that you're going to understand what you're looking at. You're going to understand exactly the allowances that you have based on the lines to work within for an entry, and you're going to understand that you're at a possible turning point. Even going to that's what the grade A signal was designed for. It's giving you the first opportunity, the first criteria opportunity in what could be a major rotation on the higher time frame. And depending on the way it's setting up, you have the option that you can go a lot heavier and only risk a very small amount on what could be a major rotational turn on the higher time frame, which could be a huge upside depending on where you think the higher time frame's headed. So but that's what we're doing. We're all about capital preservation and staying in the game. It's unbelievable. Just to give you guys, it's not unbelievable. It's funny because we got a lot of people that like our program. There's a lot of people that we've been fortunate to work with, but you want to talk about a correlation. We had a huge blast of people getting in the program back about 3 months ago. Just everyone is excited, and one of the predominant markets that we always talk about and trade is dollar CAD, especially people in the U.S. because the dollar and the Canadian markets they move mostly with our time zone. So if we are especially trading Forex, we try to trade things currency wise that correlate with our news and our fundamentals, so they move in the time frames we can actively trade. So, but the dollar CAD started to go in a box. Well, I'll pull it up real quick just for. So, and I'm a big proponent of the weekly chart, especially for longer term positions. Okay, right in here, when we went into this box right here, and I was talking a lot about trading the weekly because the weekly leads to big runs. You're talking about, 5, 6, up to 10, 12 weeks, we can go in one direction. And these are, for someone that swing trades, this is the jackpot of the year. It's going to happen usually a few times a year. No matter what you're trading, you're going to get some big weekly runs, and that's when you rake it in. That's when all the time you spent on the screen testing setups, controlling risk, being patient. That's where when you spot it and you're there because it's a market you specialize in. That's you get you get a that's where you pull off your year on according to trading on these time frames. You're counting on this stuff. But I was talking about trading the weekly using the 4 hour and the 1 hour, and we went into this price action right here. And we had normally we have a pretty good retention rate for people that stay pretty long term. The people, I'd say 10 to 15% of people that sign up never leave. They understand that once you look at boxes, you understand this type of thing. They're not going to look at anything else. But there's a lot of people that are just testing the water. They combine our system with other things. They muddy everything. They don't do anything that we say to keep it simple, and they usually bounce out. But when we went in this price action here, they're just like, this doesn't work. And we got a bunch of unsubs. And I'm just like, look, it's just people just can't deal with it. They're going to have to deal. They're not going to live through the cycle of the market, and they just got a little bit beat up in dollar CAD because they don't have the experience to understand the cycle changing. And next thing you know, here comes a little wave of unsubscribes, and they're off to the next thing and the next indicator and the next settings and adjusting and finding their golden egg system. But it's so funny that you can almost predict people's enthusiasm by the price action in the chart. And then when things start to trend, next thing you know, this is brilliant. I can't believe that that I didn't have this before. And it comes down, guys. There's a pattern. If you guys understand the cycles of the overall market, you understand when you guys have good months and when you have bad months. And that's essentially what we're trying to teach you. You have to live through these things and be quick to spot when you're going sideways, because at the end of the day, the consistency is identifying trends regardless of what you're using. And you have to stick with a currency pair or whatever you're specializing in to be there to maximize those opportunities. And you have to start to lay off when the conditions aren't so great, or there's kind of a question mark behind what's going to happen. So, and like I said, it's reflected in people's enthusiasm through the emails that come into us. It's incredible. And you can really see through that, you can really start to understand that this market is driven by people and their beliefs and how they feel. So if you guys, regardless if you stay with us or not, if you understand that that's what drives the markets is people's enthusiasm, the people jumping into the trends, fueling the next big idea, the next Bitcoin, the next big thing. It's all fueled by their enthusiasm. And then when they start to feel wrong or they start losing money on it, then it drops off with that. And that's literally, it's everything about the markets. If you guys want to do some reading, you guys can read some of Richard Wyckoff's material, Jesse Livermore. These are books and things, stuff that was guys in the early 1900s, traders, and the stuff holds true today. It's all just buying and selling and people's beliefs and understanding that's what powers it. So I'd encourage you guys to take a look at some of that. But anyway, again, another rant. Sorry about that. I'm going to go ahead and sign off here, guys. Hopefully you guys got some good tips from this. Like I said, we just want you guys to have a good tool to be able to use it for the market. And like I said, our long-term goal, if you guys don't see it, if it's not useful to you, then it's no hard feelings on our side. If you want to go somewhere else, it's fine. We want to find the people that get value in the framework, that feel that feel that the information is useful and are able to execute with it, and most of all, people that are committed, because it's not going to come in one day. Anything that you guys are trying to do, you have to build experience with it and develop a sense of intuition with those tools that you use. We're really looking ultimately for those people that want to be with us for the long haul, and that's what we're after. So anyway, we're happy that you guys are on. And we're excited. This expansion index is pretty cool. Not going to lie. I really like it. and I'm excited to give that to you guys and start getting some feedback on that. And we do have some other updates. Just to mention a few, I know I've talked about them. The next version of ATS, the actual base chart mapping, we're going to let you guys change all the colors and change the candles. If you guys want to run raw candles on it, you will be able to do that, where they stick on, so we're going to solve a bunch of those problems. I try to keep the colors consistent just for the sake of when you're talking about a red line or a green line or a white line, it's like everybody's looking at the same color. So it lessens the confusion. That's why we locked it down the way it is. But there's been enough people to say they would really like to change the color, and ultimately, you're going to have to learn what an expansion line, what a liquidity line is, and what a box looks like. Hopefully you guys can all identify the box regardless of what color it is. I would hope so. But anyway, we're going to do some adjustments like that to give you guys a little more creative control on the visual. And yeah, so we got that stuff. And then also one of the other things that's in the works as well from a coding standpoint is the new ATS Assistant version that will give you a filter for in-trend signals only. If you want stuff that's only in line with your higher time frame, you'll be able to get that. And then it'll also have a time blackout filter. So if, for instance, if you're trading short-term time frames, like say you're using a 5-minute into the hour for entry, you're not going to be interested, or you shouldn't be interested in trades that are between the New York and Asian markets, especially if you're trading US based markets. Dollar CAD, you don't want anything that's after those peak market hours. You don't want to get signals. It's just confusion. You want to even be tempted to trade. So you'll be able to black out those times, and then you'll only get the grade A and B setups during the times that you guys want to that the markets are really active. So those are just a few of the things we're working on. Just know that we're here for you guys, and like I said, our goal is to give you guys awesome stuff and for you guys to stay with us a long time. It's the only way this makes sense, to give this away at the price that we do. We could sell this for a lot more money as a black box, blah, 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 blah. But we want to give you guys the idea to stick your toe, the option to stick your toe in the water. And if it makes sense to you, which we only want you to be on it if it does, and hopefully you'll only be here if it does, we want you for the long term. We're not in it for, try it for a month. If it's not for you, fine, no big deal. But for those of you that it is for, we want you guys here for a long time. And at some point, we will not offer it once we get enough people that stick, that get it. This is that's ultimately, we'll just shut it down and just run with those people. I don't have any ambition to have every trader in the world on this, and I don't really want every trader. I just want the people to get it and get the value from it. So anyway, that being said, I really appreciate you guys. Thank you for being on. Again, if you need any help, support at tradeats.com. We're here for you. Other than that, I wish you guys a great day, evening, afternoon, wherever you are. And we will see you guys on the webinar next week. And as these things become available, just make sure you guys check your emails as we send you updates, and that way you can kind of be in tune with what's going on. So anyway, thank you guys, and we'll catch up with you later.